Welcome back to the Educated Home Buyer, where our goal is to help you buy right, borrow smart, and build wealth through real estate ownership and financing. Last week's episode, we discussed closing cost, and one of the most common closing cost fee that comes up is the idea of paying points, Josh. And it's something that we didn't dive into in that episode because it needs an episode in and of itself because it is so detailed and you can go down a rabbit hole in talking about it. So I want to spend a little bit of time today and talk about points, the idea of paying points for someone to do your loan, the idea of discount points, paying points to buy down your rate. So Josh, let's kick it off and just talk about points in general to give people an idea of what we're talking about. And then we'll go down that rabbit hole, so to speak, on each one of those.
No, Jeb, I was thinking the exact same thing as you. Like, this is a common question. It's a common misunderstandings around this topic. And when I have a borrower ask me and we're having a conversation, you got a minute or two to go through it. And there can be a lot of detail. You and I were just talking before the show and we're like, well, are we talking about this? Or are we talking about this? And that's a topic that you and I know like the back of our hands from your time in the mortgage industry, from you being a realtor, from me doing loans every day. So it can be an area of confusion. We hope to clarify a lot of that stuff for you guys today. So part of the conversation is, let's just start with what is a point and then talk to you about the different types of points and what they're used for. A point is simply a percent of the loan amount. The easiest way to understand it is if we talk about a full percent. So if you pay 1.1% on a $300,000 loan, that's $3,000. So those points can be used for different things. What Jeb and I talked about prior to the show, and it's funny, it tells you that we're old, because back in the 80s and even in the early 90s,
Watch it, bro.
Back in the 80s and in the early 90s, it was not nearly as common for 0-point loans. Now, if you're 35 years old or 30 or 40 even, you probably don't remember a time when nearly every loan came with points. And that was because that was how the lender was compensated. You paid some money up front for the loan, and then separately you had your interest rate and what charge there was for the rate. So a loan origination fee was commonly 1 point, 1.5 points, 2 points, whatever the lender wanted to charge. And that was just their profit.
So I think you said something important there, Josh, to point out. When you hear origination fee, are you paying an origination fee? If somebody asks you that question when you're getting a loan, that is a point. That is what they're talking about. And sometimes it's not a point that you're paying. Maybe it's a percentage of a point. Maybe it's you're paying half a point, or you're just paying a fee. Maybe it's $3,500, but your loan amount's $1 million. You're not paying a full point, but you're paying an origination fee, which in turn is a percentage of a point. So it's all the same thing. It's just a matter how you look at it. And I think it's important as a listener to understand that.
And Jeb, in the last episode, we talked about box A of the loan estimate. Any points that you pay, because they're going to be paid to the lender, are going to show up in box A of your loan estimate. If it's an origination fee, meaning money going to pay the lender, it should say origination fee. If it's discount points to lower your interest rate, which we're going to primarily be talking about today, it's going to list them as discount points. Other fees will also go in there, and those are technically also profit to the lender. But when we're talking today about points, it's origination fee, which for the most part, people don't pay. I don't think you should be paying an origination fee. We talk about our things negotiable all the time. If you see an origination fee in box A, push back and ask them, why am I paying this? Most lenders get paid when they sell the loan and profit from the whole loan sale. So we're going to be talking about discount points because for the most part, that's what people are asking about. Should I pay points? Discount points to discount my interest rate. So we talked about a point being 1% of the loan amount. Jeb talked about it can be a fraction of a point, quarter point, half point, 3/4 point, and they don't have to be even numbers. Oftentimes I look at a rate sheet and I send out a quote to someone and it'll say, you can do 0 points at 4%, or you can do 3.75, and that is 0.921 points. That's literally how granular lenders get with this. So don't get hung up on it being 1% or 0.5% or 3/4%. It can be literally any percentage of the loan amount. So what is the purpose of discount points and why would you like to pay them? On any given day, a lender does not care what interest rate you pay. They have a yield that they need or want based off of the market on money that they're lending out. So a super simple example here. If you borrow $100,000 at 4% interest, that payment's $477 a month. But in interest, the 4% is just a hair under $4,000. So the lender knows in the first year, they're going to get a yield of $4,000. That's their gain on loaning out $100,000. So lenders happen to know that when they loan 10,000 loans, when they make 10,000 mortgages, those loans on average are going to run about 5 years. People are in their homes longer than that. The current average tenure of a homeowner is over 10 years in the United States.
But now, is it 5 years because people refinance and pull cash out? They refinance lower rates? Is that the idea?
Bingo. And we'll talk about that in the context of the last 40 years. Since 1982, we're in a decreasing rate environment for 40 years. So it's a constant decreasing trend, but it doesn't mean that rates go straight down. So sometimes they're a little higher, but in any 2, 3, 4 year period for the last 40 years, we've had a dip in rates and an opportunity to refinance. So you might only move every 10 or 11 years, but on average, those loans are going to run about 5 years. In the last few years, it's been way less than that. So from their perspective, they're looking at saying over 5 years at $4,000 roughly interest a year, we're going to make $20,000 loaning out this $100,000. Now, you may be in a situation where you want a lower payment or you absolutely need a lower payment just to qualify for the loan. I have a client in that situation right now that we don't have a choice. We have to buy the rate down to get his debt to income ratio in line. So let's say if you had to get your rate a 0.5% lower, that costs, a rule of thumb, is about 2 points. Now, what happens in this situation? On this hypothetical $100,000 loan, 2 points is 2% of the loan amount, or $2,000. So at closing, you're paying the lender $2,000. And in return for that, the lender says, cool, you pay me 3.5% interest, which lowers that payment $28 a month. So your payment goes from $477 to $449, a $28 a month savings. So in the first year, it cost you $2,000 in discount points to buy the rate down. You saved $336 in interest. Now, over 5 years, that comes out to $1,680. So in this hypothetical situation, which is pretty close to accurate, the lender wins if you pay off in less than 5 years. You have to get almost out to 6 years before the break even. But hopefully what you're seeing with this is the lender doesn't care. They want their money. They want their yield on the money. They can get that in you paying them some money at closing and a lower payment. They can get that from you paying them no money at closing and getting the payment that they want. They can even go the other direction, and if you'll pay a higher interest rate and give them more in payments over the life of the loan, they'll pay you at closing, which you may want or need to cover some of your closing costs.
But before you dive into that, though, Josh, I want to talk. So is the rule of thumb, it's always just over 5 years, or is it different at different rates and different loan amounts?
It because it's all percentage based, different rates, different loan amounts don't really matter. Different loan programs can be priced differently. And the further we get away from that hypothetical par rate, which you could be listening to this podcast at any point in time. So I don't necessarily want to say what that is on any given day. But
and what is a par rate? Just so the consumer, the listener knows.
Yeah, absolutely. Par is that interest rate where the lender doesn't pay you a lender credit and they don't charge you any points. It's essentially that 0-point rate. This is what the rate is today that we want before you discount it or adjust it to get a lender credit.
Now,
so
let me go one level deeper. So at that par rate, how is my lender getting paid? Like, because I don't want to pay that lender. So how you, as the mortgage professional, how are you getting paid in that situation?
So for us as a broker, the lender pays us at closing. We set our compensation and we say, hey, every loan, every lender, we want to make X% of the loan amount, and we get paid that when the loan closes from the lender. And people go, oh, the lender has to pay you, so we'd be better off going directly to the lender. Nope, because they have a retail operation. They also have a loan officer. They have a processor. They probably have a more expensive brick and mortar office than what we have. So you're getting a retail price from them, even though you could probably go directly to many of the same lenders we close your loan with, or you come to us and we give you a wholesale rate and the lender pays us based off of where we set our compensation in there. So for the most part, if I went and looked at the 218 loans that we did last year, 90% of them either paid 0 points or got a lender credit, and maybe 10% for various reasons did choose to pay points to get a slightly lower interest rate.
Okay, so some things I've heard you say that I want to point out is it cost about 0.25% of the loan amount in order to buy down. I'm sorry, it cost 1% of the loan amount to buy your rate down about 0.25%. So that's in theory the most common number, I guess, or what you're using when having the conversation with most buyers, and that might not be exact, right? It might not be a quarter. It might be a little bit more, a little bit less on any given day. Secondly, I heard just over 5 years in order to, in this example, to recoup your costs. Now, what if I'm a buyer and I say, you know what? I'm going to live in this house forever, Josh. I'm never going to refinance. My parents never refinanced. They paid their house off in exactly 30 years, and that's my plan. In that case, does it make sense to pay down points? Like, when does it make sense to pay that fee to the lender, to buy down your rate? Because everybody wants the lowest rate, right? We saw rates this year. I mean, people were getting 2.5% sometimes on interest rates, but if they bought it down a little bit more, they could get 2.25 or whatever it was. And so, does it make sense to pay it down?
Well, think about this, Jeb. You had two very high-performing videos during COVID that one of the biggest wholesale lenders in the country did a huge PR campaign that they were offering 2.99% interest rates. Now, we know that rates ended up going much lower than
1.99.
that. Well, 1.99 was their 15-year that they followed up with
Right.
later. They originally started at 2.99, and everyone's like, "Oh, that's amazing," because rates at that time were like 3 3/8, and people were like, "This is wonderful." Well, from the lender's perspective, they said, "We don't want to put loans on the books at 3 3/8 when we, in our much better crystal ball than the consumer, believe rates are going lower." So what they were doing is they said, let's make this wonderful offer. We'll get PR saying we're offering 2.99 rates, which no one had ever seen a rate under 3%, but you're paying points to get that. The only time, I shouldn't say the only time, there's really two primary times when paying the points makes sense. If you tell me I'm not going to refinance, my parents never refinanced, I'm philosophically opposed to refinancing, I will look back at the last 40 years, I will show you the chart, and I will tell you you are wrong. You're costing yourself money and leaving money on the table. But if you look at that chart and you go, cool story, bro, I don't care, this is what I want to do, then we can run those numbers and show you what it looks like. So the biggest reason why we don't want to have bragging rights like that 2.99 rate or the 15-year that they eventually did at 1.99 and paying points for it is we're probably in the near future, in the next 3 to 5 years, going to get an opportunity to get that interest rate for free in a 0-point loan or a no cost loan. The more common situation that I have is a senior coming in and saying, "Hey, I'm going to retire in 2 years." Jeb, we have a mutual client that referred their parents about a year before the dad retired. He's 68 years old. He knows he's going to be retiring next year. They said, "We want to refinance and we want the absolute best lowest rate because we're not going to have this big income to qualify off of anymore." Perfect. That makes sense. If you're not going to be able to qualify in the future because of retirement or something else that's going to change your income situation. The more common reason is the client that I mentioned earlier, that literally prices have gone up and interest rates have gone up. And if we do not buy that interest rate down, he doesn't qualify for the mortgage. So his option is either don't buy or pay the points. So we can't just broad brush strokes and say never pay points. Like I said, last year, 90% of my clients, if I ran the numbers, did not pay points or got a lender credit, but 10% did. And there's valid reasons why all of them did. And it's probably some combination of the two that we just talked about.
No, and I'm sure you can give multiple examples of people that did buy down a rate at some point and then rates went lower and they ended up refinancing to an even lower rate just a couple short years later. I mean, hell, we saw rates go down from what? I mean, mid four. Where were rates in 2019? 4 or 5, 4.5%?
In late 2018, they were touching the high fours, almost touching 5%. So
Right.
think about that. Before we got to COVID, we had gone from 4.875 to the high threes, 3.875, probably a full percent reduction. And the best example I can give of that, Jeb, I have a client that came in super well qualified. He was putting 20% down, 800 credit score, and in late 2018 when they bought, he is just beside himself. The rates had gone up so much, and instead of looking at 3.875, 3.75 that he would have looked at a year and a half earlier, he was literally, I think it was 4.75. He says, well, here, I have the money. I want to pay 2 points. How low can I get it with 2 points? So we look, is it 4.75, or if we pay 2 points, we can get you down to about 4.25. But on his purchase, it was a 450 purchase, 20% down. It's like 360, $7,000. We went through the charts. I showed him that 40-year chart. I showed him all of the things that were happening at that time that we felt that this was a short-lived bump up in interest rates. And long story short, he didn't do it. He didn't pay the points. He took the 4.75. We refinanced him in the middle of 2019, about 8 months after he bought, down to 3.875 for free. Then COVID hits and we got him down to 3.25 for free. And then COVID gets worse. You saw everything that happened with rates last year. He ended up at a 2.75. So from 4.75 to 2.75 with 3 refinances and never paid any money out of pocket. We covered all of his closing costs on all of those. Now should we count on that happening going forward? I wouldn't. I mean, 4 refinances in 4 loans in a 3-year period is extreme, but that's what can happen in terms of the best case scenario. More likely that happens over a 10, 15-year period, but it does happen.
Well, and another thing I've seen, from my days in lending is that people pay points or fees or what have you to buy down the rate. And then what happens is equity increases in their property over a period of time. And they're like, you know what? I'm going to pull some cash out and do some remodeling, or I'm going to pull some cash out and do some consolidation on debt or what have you. And they end up refinancing anyway. And whether it's the same rate or slightly higher or whatever, they're just looking at the cash out and forgetting that, that they paid the points down just a couple of years later. So just, if you're one of those people that are a serial refier, if you will, somebody that really, and serial refining isn't a bad deal if your rate is going down each time and it makes sense. I mean, I'll give you an example. My mother-in-law, every time rates get to a point where she can refinance and it makes sense, she takes advantage of it because, again, fixed incomes looking to keep their payment at the lowest possible rate. In their situation, it would never make sense to pay that fee. So if you're one of those people that are always looking for the best rate, probably doesn't make sense. But on the other hand, if you're the person that plans on keeping that loan forever, like my family, they grew up in a completely different world. And I can almost assure you they have the same loan that they've had for the last, they moved in that house in 2008. No, 2008. No, I'm sorry, 98. And they're probably in the same loan that they were in 98. So,
Jeb, here, let's use your example there because it's a very good example. What would you guess your family in North Carolina owes on that home?
Oh, dude, it's probably 30 grand at this point.
Okay, let's say it's 90 grand, and your family here in Southern California probably owes $500,000.
Right.
So when you look at that, it's very easy to justify a refinance. We talk about our rule of thumb on a $500,000 loan. The rule of thumb is take $125,000, divide it by your loan amount, and it tells you what percentage you need to save to make a no-cost refinance or a no-point refinance make sense. So we take 125, divide it by 500. Your family here in Southern California needs to save 0.25% to make it make sense. When we use that same example in North Carolina with a $90,000 loan, 125 to 90, we got to save 1.5%.
Well, if you use the $30,000, they got to save 3 points.
and Jeb, on the live that you do every week, we get that question all the time from people in other areas. Hey, rates are way low, and I've got a super high rate. This is when rates were down in the high 2s. Say rates are super low, and I'm at 4.5, and my bank is telling me it doesn't make sense for me to refi. Okay, well, cool. How much do you owe? I owe $29,000. Well, the fixed costs of a refinance, even for the tiniest loan, are $1,500, $2,000. Yeah. So what did we just talk about? $2,000 on that. That's 4 points in cost just for that little tiny loan before you pay any points for your interest rate. So it does impact the equation of how big your loan is, what part of the country you're in, and your willingness to go through the loan process and work things as they come down. So an important thing that you said, Jeb, is, hey, you have your plans and I'm going to be here, I'm not going to refi, and I want to pay 2 points. But life changes. You have a baby, you need to add on a nursery. You have an elderly parent need to move in with you. You need to remodel and get a downstairs suite for them to live in. So long story short, we plan and life goes, ha ha ha, that's funny. And things come and plans change where you move, you get divorced, you get a job transfer, you have a family member need to come move in with you. The lender, on the other hand, the reason why this math works out well for them is they're making thousands of loans. They don't care about the one of you that stays in the home for 14 years and comes out ahead because you bought the points and got a lower interest rate. They look at it and they go, for every one of those, someone's going to pay us 2 points and sell the house in a year or refinance in 2 years. So the numbers in aggregate work out for them. You're trying to decide for yourself. So there's no right or wrong answer above and beyond. Calculate the numbers, know what the difference is. Jeb, you and I, we have a friend who created a pretty cool tool for comparing loans. And in looking at it yesterday, the most important thing that I thought about this is how many people work with lenders that don't give them any tool for comparing.
No, for
Doesn't
sure.
matter
We hear
whether
it
you
all
have
the time.
the doesn't matter whether you have the best or the worst tool to compare, but did the lender give you anything other than, it's going to be 3.75%, and this is what your payment is, and this
No.
is maybe how much money you need at close. Like, you need that breakdown, and you need a side-by-side comparison. I don't have a problem with my client making any decision that they believe is in their best interest. I want to make sure I provided them the comparison and a cool side-by-side where they can quantify it and go, cool, Josh, I hear where you're coming from, but I'm confident this is the right decision for me.
No, absolutely. And now the next thing we're going to talk about today is how we pay for those points, right? But before we do that, I'm going to take a minute here and do a little plug. If you're looking for a lender that can go over this information, that breaks it down, because I mean, if you're going to pay points or even consider paying points or origination fees or any fees, your lender should be giving you a side-by-side comparison of origination fee with no origination fee. What's the difference in rate? Buying discount points, not buying discount points. If that's the decision you're choosing, what's the difference in my payment? How long is it going to take to recoup my cost? If you're not getting that, you need another lender for one. But if you need a professional mortgage expert anywhere in the country, there's a link in the show notes. Happily refer you to somebody that does, is a professional and knows what they're talking about, can guide you through the process, does business the way that Josh does. So click on that link, get referred. But Josh, let's go back here and talk about cost. If I want to pay origination points or I want to pay discount points, can I roll them in the loan? What if I don't have additional fees to pay that, that amount to buy down the rate or whatever?
So, two different types of loans, purchases and refinances. And we talked about this in terms of the closing cost discussion last week. On a purchase, your loan to value is determined by the purchase price or appraised value less your down payment. So if you're putting 3% down, you can't finance any closing costs because we would be making your loan larger and you wouldn't be making your minimum required investment. Now, if you're putting 30% down and you say, hey, I want some points and I want to finance them, the way they're financed is by putting less down and getting a larger loan. So it's always on a purchase going to impact your loan to value calculation. And the lower that is, so the bigger the down payment, the lower the loan to value, the better your terms are going to be, generally down to about 60% loan to value or 40% down. Now, on a refinance is where it gets more common of people paying and being charged points. The literally number one largest lender in America is famous for, they want to charge points on everything. They're a retail lender. The kids in the call center are going to tell you you're not paying points. You get your loan estimate, magically there's points, and they'll give you a reason why that's not really points. But in box A, you're seeing you're paying origination or discount points. And when we look at that, it's super easy to do on a refinance because you are thinking less in terms of how much am I putting down and more in terms of my rate and payment. So if you're talking to someone that is only selling rate and payment to you and saying, hey, don't look at box A, and you're giving, trading $8,000 of your equity to have bragging rights for the lowest interest rate, that's a problem. But you are absolutely on a refinance able to do that because what are we talking about, Jeb? The average loan to value on homes in the US with loans now is under 50%. So the average person that we talk to, you can finance as many points as you want. Now, practically, within terms of, inside baseball terms that we're limited by on this side, there's a thing called bona fide discount points. They can't exceed a certain threshold. So in reality, 2.5 points is the most anyone's ever going to pay. So when we're looking at that, and it's the same on the flip side, if you're looking to get a lender credit, 2.5 points is about as high as it's ever going to go. So if we say the par rate on any given day, the rate that's 0.0 lender credit is 4%, the range of rates that are actually going to be closed are going to be 0.5% below that, down to about 3.5, or 0.5% above that at about 4.5.
No, good stuff. So, you know, hopefully as a consumer, a home buyer gives you a little bit more information there. I mean, I haven't been in the lending business in 10 years at this point. And a lot of these were good reminders for me. And I know a lot of consumers out there don't have that knowledge. And quite frankly, like you said, Josh, to start this, you having a conversation with a buyer, you typically don't have 30 minutes, to be able to go over points. So, hopefully this was helpful in guiding you through that process. But next week, we're going to go even deeper into the home buying process. So stay tuned as we help you become the educated home buyer.